Hi, this is Kelly Wright at the Money Show, and joining me today, Mr. Zach Jonson of Stacks Investment Management. So, we're both stock pickers.
Yeah.
That's our reason for being here, and this is what people pay us to do. In an earlier segment, you mentioned financials.
Mm-hmm.
And on my screens, I see a bunch that show up.
Yeah.
That look really, really good to me. What looks good to you?
So financials for us is something that we do have a small allocation to it, but overall it's not a place we're looking to buy or increase overall focus right now. Now, healthcare is interesting right now.
I agree.
Healthcare is, valuations, honestly, even about a year ago, were not looking nearly as attractive as they are now.
Right.
Now, there's a couple headwinds, of course. We're coming up to an election season.
Right.
And
there's some candidates that do not like
the biggest punching bag really comes down to the healthcare sector.
Always. Every 4 years.
Both sides of the aisle, and it's going to be a unified front when it comes down to it.
I know, it's rough.
But from a fundamental standpoint and looking at the bottom up, we do like healthcare. So I'll give you a specific name. Stryker is a name that we do like.
Sure.
And Stryker continues to garner market share, continues to increase their overall market share, and they're taken away from other companies. And they've consistently produced about 8.6 to 9% sales growth over the last 10 years.
That's strong.
And that's something that we really like, because that's a consistent fundamental and quality growth of sales.
So remind us of the symbol?
SYK for that one.
SYK, okay. What do you guys follow AbbVie, ABBV?
We do. We have followed AbbVie in the past. It's not something we're focusing on this. The biotech segment is very interesting right now, especially from a valuation standpoint.
I know. What do you think about that acquisition of Allergan?
Well, that's an interesting point. And some of the and speaking of that acquisition specifically, but other ones, they're starting. We're ebbing and flowing between this idea of being a conglomerate and being more focused on your core business.
What do you want to be?
Exactly. And so that is our one worry with that general acquisition is, are you trying to be too much to too many people?
Yeah, that's you're skating on the knife's edge right there, trying to figure out what you want to do, what you want to be.
Yeah.
And then I got to ask you, because I really appreciate your guys' research and the way that you dig into balance sheets and income statements. Mm-hmm. What do you think about old stalwarts like an Altria Group or a Philip Morris International?
Mm-hmm. So, dividend yield attractive, obviously.
Huge, yeah.
Stock market prices have gone down quite substantially.
A ton.
And there's a ton of overhang from that standpoint, obviously, with what's going on across the board. We at this point, it's not something that we're screening out, we're looking at. Okay. I think, like you said, from a fundamental standpoint, the valuations look attractive.
They do.
It's not really an area that we like. Now, we are talking about the consumer staples segment of the market.
Right.
I'll give you a name that we do like, and it's Walmart. And what's fascinating about Walmart is it's not because of its consumer staples focus. That is their core business. That what really gives them the baseline to focus on another segment, which includes grocery delivery and e-commerce growth.
Yeah,
and
they've done a great job.
They've done an excellent job.
They've done a fantastic job. Yeah.
And if you look at a company that can somewhat compete with Amazon, especially going forward. Walmart's got the footprint, and Walmart has the attractive or the ability to have the logistic background that can really challenge Amazon.
And I've always thought that one of the advantages that Walmart had is they've got so many bloody stores.
So many stores.
So many stores. You can't go anywhere.
No.
Where there's not a Walmart, And you do that thing online where, look, I just can't wait for tomorrow.
Yep.
I can order it and I can go pick it up at the store. And I think it's a great advantage.
It's over 11,000 stores global. That's a huge footprint, obviously.
Yeah, it's like McDonald's,
That's right.
I tell everyone, who will listen, that McDonald's is a REIT, and they all look at me and go, what are you talking about? I said, come on.
Yeah.
They own the greatest real estate in the world,
It's very true.
And the valuations aren't that attractive now. But
yes, you're right.
Anything else on your screen?
I'll give one last name to finish up with. And earlier we talked about the energy sector.
Yeah.
And generally valuations look attractive, but there's a lot of headwind. There's a lot of issues with that sector.
True.
Chevron is a company we continue to like, and really the key reason about Chevron is that management team. They were the first management team in the energy sector, in my opinion, that saw what the environment's going to be like from a commodity standpoint.
Right.
Oil's going to remain relatively low, and they were the first to react to it.
LNG.
Yeah, exactly.
Huge.
Exactly. And
Huge.
they've stated numerous times we're going to stay cash flow focused, we're going to stay yield focused, and we're going to grow, but we're going to grow at a very smart clip. And that combination really makes Chevron probably the most attractive name in the space.
I'm
overall.
with you. I love Chevron. You know, I've got some exposure to Exxon, but that's a horse of a different color.
Yeah.
But yeah, I'm with you on that.
Yeah. Excellent.
It's good.
Excellent.
This is good stuff.
Yeah, this is great.
You guys should check this guy out and go to Stacks Investment Management. There's some of the good guys on the street. Zach,
It was a pleasure. Thank you very much.
I enjoyed it. This is Kelly Wright at the Money Show. Thanks for joining us.